Hello and welcome back to the channel. In this edition, we'll be looking at a company associated with insurance sector. And there are a lot of companies which are more popular and which are more talked about. Like I think Life Insurance Corporation of India is the most popular of the stocks that are listed. And then we also have some of the other private insurance players, both in general insurance and life insurance as well. And recently, a lot of these businesses were in news because of a change that the regulator made. The regulator came out and said that uh, the, that there will be a limit to the amount of business that could be written through the bank assurance channel, and this caused the stock prices of a lot of these companies to fall because within the listed entity space, there is ICICI Lombard, there is ICICI Prudential, there is SBI Life Insurance, and HDFC. So these are heavily dependent on the bank assurance channel, and because of which there was a drop in share prices. Now, I really went on to see whether the drop in share prices really makes the valuations attractive, or there is something which I can pick up for the long term. And unfortunately, the price to earnings multiple that I see are still high for most of the companies that are listed that I saw. When I was looking through it, I did come across General Insurance Corporation of India. This is listed at a PE of close to 9 and has a dividend yield of close to 2.5%. And General Insurance Corporation of India is the largest reinsurance company of India, and it manages close to 67% of the of the reinsurance premiums in the Indian domestic market. Its presence is not only within the Indian domestic market, it also has a presence internationally. But internationally, what is beginning to happen is in some of the geographies like US, it did have a credit rating of A minus, but that credit rating did get withdrawn. Um, and it is working towards regaining that credit rating. Um, because of the withdrawal of that credit rating, it has impacted its business, and it hopes to regain the credit rating of A minus, and then because of which it would see significant businesses coming from abroad as well. So we'll quickly jump into the investor presentation of GIC Ray. First, we will look at how really what is reinsurance and how reinsurance works. To put it plainly, what reinsurance really means is when we as policyholders go and buy insurance from an insurance company. Insurance company is an entity whose capital will be limited. So to diversify, to put less constraint on the capital, what they do is they take. So suppose if we give them 100 rupees worth of premium, and they feel that out of that 100 rupees, the claim that may come on that 100 rupees can be higher and may place constraint on the capital. So to ease out that process, what the insurance company does is it goes and cedes its risks to the reinsurance companies, and GIC Reinsurance is one such company. Now, when the reinsurers want to make their book lighter by ceding some risks away, due to capital constraint that the reinsurance company may have, then that process is called as retrocessioner. So here we see the first level is policyholders. We buy the policies from the direct insurers. When the direct insurers want to see their risks and want to make their profits less volatile and want to keep the capital book asset book light, what they do is they go on to cede the risk to the reinsurers. And when the reinsurers do want to again do the same thing that the direct insurers did, then they go and see the risk further, and that process is called as retrocessioner. Now we'll look at the role that the reinsurance industry plays before jumping into the key figures that GIC Ray has. And now GIC Ray has been playing a key role in the Indian reinsurance market, and it is able to maintain about 60% share in the Indian reinsurance market. So FY23 numbers, it was close to 67%. There is also close to 11 foreign reinsurers which have entered, and although there have been some provisions which are made so that the regulator ensures that the premium stays within India. One of them is the right to refusal. So whenever there is also the concept of obligatory session to the GIC rate. So for example, if 100 rupees worth of business is written, the first 5% is always ceded to GIC rate. And even when the direct insurers are thinking about ceding their risks, the first right to refusal remains with GIC Ray. So if GIC Ray refuses, then only the business can go on to be given to the foreign insurers. But this is a regulatory thing, and this may change in the future. But uh, I did hear the management speak about what will happen if the right to refusal does change, and what they believe is that they are currently working with all the insurance companies, both general insurance and life insurance. They have been working since a very long time, and they have very good relationships with these general insurance and life insurance companies, and they have made very stringent underwriting changes as well. Earlier, what used to happen a couple of 2 3 years back, that they were writing close to 50,000 crore worth of revenue, and on that 50,000 crore worth of revenue, they were still making losses. So they were making losses to the tune of 250 crore. So the management really went in saying that we need to weed out the accounts which are bleeding for us, and we need to be able to select businesses which are more profitable. So they did that, and right now, although there has after that they did see a degrowth, and since then, um, right now they produce profits upward of 6,000 to 7,000 crore annually. So reinsurance is the foundation for economic growth through risk transfer mechanism, which is what we were talking about. So how it moves from the direct insurers to the reinsurers, and if the reinsurers do want to transfer risk as well, then they take reinsurance on their books as well, further reinsurance on their books. The risk flow through insurers to reinsurers. Insurers written on the strength of reinsurance support, and reinsurance insulates himself from the insurer's adverse financial performance, and reinsurers have devices to guard against anti-selection. Right. So, what is the really the role of the reinsurance companies is to provide insurers capacity to write more. So that is one of the biggest support that the reinsurance companies provide to the insurance companies. It provides insurers protection against bottom line volatility. So if you are able to seed some of the risks which are highly likely to generate a lot of claims, then you can control the volatility on the bottom line, volatility of the profits, and that is something the stakeholders always ask for, right? So um, no major surprises in terms of bottom line. They would always want to project the numbers right uh, out to the first year, second year, third year, fourth year, fifth year, and be able to predict profits um, very convincingly. Although this becomes very difficult in insurance sector because of a lot of factors. So what is really happening is, because of climate change, we are seeing floods in areas which we never saw before. So we saw floods in Dubai, we saw floods in Spain recently. So what really happens is, when somebody is writing reinsurance in these areas, they will not factor for a catastrophic event as much as they would, for example, in Japan. So, so the rates will be lower there. But when a cat event does happen out of the blue, then it causes losses to the reinsurance companies. So here we are looking at the global scenario, and what we are really seeing is that from 2010 to 2020. So for all of the regions, um, we are seeing what is the growth, CAGR growth rate. So the CAGR growth rate was close to 5.3% in terms of the gross written premium from 2010 to 2020, but it has slowed down to 1.6%. Um, and a lot of hardening of insurance rates have happened. So what does hardening of insurance rates means is, so for example, if the reinsurance companies were taking 5 rupees worth of risks for 1 rupee before 9/11, after 9/11, because of a huge terrorist event and a lot of payout that needed to be made, the reinsurance rates become more expensive, and this directly impacts the prices that we pay as retail consumers as well of insurance companies. So if we do go out and buy our motor insurance, then the direct insurers will price in the hardening of the reinsurance rates within their premiums of motor insurance as well. So this has a direct impact on the retail investors as well, retail purchasers of insurance as well. So here we see that Asia, excluding Japan, has seen the highest growth in terms of property and casualty CAGR. So 7.9% growth and 8.9% for the life insurance business. But really, the global growth rates are muted. But also because the global GDP growth rate is also in this range, so most of the developed countries are growing at a subpar growth of less than 2% or less than 3%, with inflation rates touching close to 6 to 7% from where they were earlier at 1 to 2%, to 2.5 to 3%. So we are seeing a global shift in terms of where the interest rates were, and these then begin to have impact on the bond yields and those kind of things, and these really begin to also have an impact on the bottom line of reinsurance companies because most of the investments are in debt instruments. So here we see that reinsurance rates rose sharply in January 2023 renewals in response to losses due to the war, high inflation, and increased nat cat events. We had the cyclone Helen in the US, and all these do play a part in hardening the reinsurance rates or making the reinsurance rates rise more sharply because then the losses are much more than what they were expected, and more the catastrophic events, more the reinsurance rates then turn out to be. AM Best has maintained a stable outlook for the global reinsurance sector on the back of positive rate momentum across a broad range of non-life classes of business. In the current environment marked by years of accumulating catastrophic losses, investment market losses, and significant losses expected as a result of the pandemic, there is potential for further price increases. And when we look at reinsurance growth, we also need to look at it from the lens of geography. And within India, what we are seeing is that a lot of infrastructure is getting built out, and a lot of shipping companies, shipping repair companies. So as and when the economy grows, its growth will be hinged back to how the insurance and the reinsurance companies perform as well, and what are some of the rates that they charge, and what those rates impact is on um, the pricing of reinsurance products across the broad spectrum of life and general insurance. So here we look at the reinsurance industry in India. So GIC Re is the largest player in India and leads most of the domestic companies' treaty programs. So to look at the gross written premium of general insurance industry in 2023-24, they wrote close to 3 lakh crore worth of gross written premium. So the net retention of general insurance decreased marginally from 71.9. So what the net retention means is, suppose we are writing 100 worth of gross written premium and we cede 30% to the reinsurers. So the net retention is 70%, and this is what they're talking about, that the net retention has decreased. So insurers are ceding more of their risks to reinsurers compared to what they were doing earlier. Insurance penetration had declined marginally to 4% in 2022-23 compared to 4.2%. One of the major change that is coming in or that is being proposed is the FDI in insurance. So government is proposing 100% FDI, and so what that will do is that will so all the companies that have stake in terms of a joint venture, they would like to increase their share within the Indian market, or they might also like to come solo as 100%, but that becomes really difficult and challenging in the initial years because local market knowledge is something which they would not have, and that becomes of prime importance. But I see less of the 100% type of companies coming in, but I do see a case for, so for example, if Kotak and Zurich, for example, if Kotak and Zurich Insurance have a tie-up, and Zurich owns a particular percentage of Kotak General Insurance, then or life insurance, then there is a case of it increasing, proposing to increase. That can definitely happen, but the 100%, it becomes it becomes difficult because obviously the local market knowledge and everything, but you never know, because these companies can then go out and hire consultants, and they can iron out some of the issues that they have, and they can come on fully onto board and come and deploy the capital 100%. Now, crop insurance has become the third largest line of non-life business after health and motor insurance. So this is a definite trend that we are seeing. So in terms of how reinsurance, how GIC derives most of its profits arise from property insurance. A lot of the profits in terms of when we talk about pure profits, business profits, come from investment income. So there is a lag between when the premiums. So the premiums are received upfront, and there is a lag between when the premiums are received and when the claims are paid out. So that lag then can be utilized to deploy assets within the investment, with different broad spectrum of assets that are available within the investment space. Um, and because of that, the combined operating ratio is a metric that insurance companies look at. And the combined operating ratio for Q2 of 2024 was sitting at 114%. But when they did combine it with the investment income, and they call it as an adjusted combined ratio, when they did club it with the investment income, it was sitting at close to 87%. So that is a very important metric to look at, because if the adjusted combined operating ratio is not less than 100, that means essentially that the business is not able to make profits even after accounting for investment income. So here again, I think some of the broad operating environment, India's general insurance market is estimated to grow at a compound annual growth rate of 9.9%. Yeah. So here we are talking about the combined ratio overall, and you would see spikes and trough because of mostly because of nat cat events, or also called as natural catastrophic events. You would see that here we had the pandemic 2019 2020, and because of which you do see these spikes. And anywhere where, so if you heard Kerala floods or Chennai floods, then you would see the combined ratio generally trending towards the upward range, and that is how it would work. So here we are looking at combined ratio split by type of insurer. So general insurers, the combined operating ratio is in the 120% range. Standalone health insurers sitting at 97.6% for the 2023 year, and specialized insurers sitting at 81%, and overall it's sitting at 116%. So what are some of the things that the business has done? Now, the one of the major things that the business has done is prudent underwriting becomes of prime importance. So really picking and choosing the risks that you want to write onto your books becomes of prime importance. And that is where some of the financial modeling comes into play. The catastrophic modeling becomes of prime importance. What you're pricing your risks become of prime importance. So this continued focus on risk selection, lines of business diversification. You want to be writing fire, motor, and so if in case there is some major impact on the business of one of the lines that you're writing, you are protected. You also go in with geographical diversification, so you're not only writing businesses within India, and if there is a effect that we see in the Indian insurance market, then you would be protected in terms of writing businesses all across the globe. And GIC rate does that. It has a counter within the Lloyd's syndicate as well in the UK, and the counter is number 1947. So here we see deployment of modeling and pricing techniques and tools. So these, and they have really done these things to really degrow from where they were 2 3 years back, and have been able to generate significant profits post that. In terms of exposure management, modeling accumulation of exposures, rebalancing the risk portfolio, and well-rated retrocession counterparties. So that is something that they're looking at. Healthy investment income becomes of prime importance, obviously, because of the nature of the business that they are in. And um, uh, pure play, they are not making profits, but obviously when you club the investment income is when you see the profitability coming in. And there has been a lot of volatility in the bond yield markets as well. That will have a significant impact. But what they do is they do not do a lot of trading of the bonds. They have locked in the bonds that they buy till maturity, and hence these volatilities that you see within the bond markets have little to no impact on their investment portfolio. So effective asset liability management and some of the businesses that they write, right? So for example, the motor third party, it has a long tailed nature of the claim getting settled, and that gives them an advantage of deploying their assets into the investment buckets for the longer duration. So there's also a difference of so for example, if you deploy your funds to a more longer duration bond, that will give a better return than when you do it into a shorter duration bonds. And when we talk about thousands and thousands of crores, the impact that it has from moving from a longer duration bond to a shorter duration bond causes a significant impact on the investment income that the business generates. So here we see that it's ranked 10th largest global reinsurer group. It's A minus with stable outlook, financial strength, rating by AM Best. It did lose it, but it's gotten back this A minus, and this is the minimum that they require to be writing businesses in some of the more developed markets in the US and everywhere. So this becomes of prime importance because they did lose out to that business, and now they are back in the hunt for that business. The company stands to benefit from price hardening in select segments. So obviously, because of climate change and those kind of things, pricing with a margin of prudence becomes of prime importance, and that is what GIC Ray is hoping on, that the prices are significant to take care of any volatility or shocks that we see because of climate change. So we'll quickly look at the financial performance as well. In terms of the incurred claims ratio, so incurred claims ratio is nothing but it is divided by the earned premium, and on the numerator you have the claims, the paid and the outstanding claims that the company estimates, and it is sitting at 92.3%. When you combine it with the expenses, it is sitting at 111.82. Solvency ratio is nothing but the minimum capital required to be floating. So the minimum requirement is 1.5, which is 150%, but GIC Day is sitting comfortably at 325%. The gross premium that they wrote was 37,000 crore in FI of 24, and the profit after tax was 6,500 crore. And this number, this gross premium number, was sitting close to 50,000 crore in FI 22. I If I recollect correctly, FY 22 or 21, and on that 50,000 crore, they did a loss of 250 crore. But now the premiums have degrown to 37,000 crore because of the risk selection that they have been very particular about. And there have been a lot of changes in terms of what they're picking up, the prices that they're picking it up at, the volatility that they have reduced on the books by ceding their risk to the reinsurer further towards other reinsurers. Those are some of the kind of things that they're doing, and because of which, at a lower gross premium number, we are seeing a higher profit after tax. So these are great signs that the business is focusing more on the bottom line rather than blindly going out and writing whatever they want on the top line. So that is a great sign. So here we look at so gross premium is 37,000 crore and net premium. So basically 4,000 crore worth of business they are ceding it to another reinsurer because they would they would want to limit their volatility on their profits. Incurred claims is coming at 30,980 crore um, with a percentage of 92.3%. So that was the net incurred ratio that we saw. Um, and here, when we look at profit or loss, underwriting profit is negative because obviously, as we discussed, the combined operating ratio is negative. But they made an investment income of close to 11,620 crores. So they have close to 1 lakh crore worth of investments within the book, and through which they are able to generate close to 11,620 crores. So if we look at a 1 lakh crore worth of AUM, that translates to 11.6%. So they have 15% in equity, and it has broadly doubled So obviously the government yields and everything will not give you more than 7%. And so when we look at the weighted average, the yields, the investment income have been higher because primarily because of the way the equity market has performed. And there may be a time when it doesn't perform, and hence obviously this profits will reduce significantly in the future. So here we see the combined operating ratio is sitting at 111.82%. And throughout, I think Q2 of FY25 and 114.05. This is what I was talking about, 114.05 for the latest results that they announced. And it has consistently been higher than 100%. So because of which you might think that the business is not great, but if you combine the investment income on the back of the significant AUM book that they have, then that is something that you can explore. Obviously, this is not a stock recommendation. You can do your own research, but I'm just laying out the facts that I see in front of me. And you can also correct me on the in the comment section if you think some of the facts that I present are incorrect. I would love to be corrected. So on the gross premium, we see that the growth, in terms of the growth, the total growth has been 5.8%. Life insurance has seen a significant growth of 22.6%. Um, and my hunch is that this would be on the back of a lot of the protection business that the life insurance companies write, because honestly, I do feel that some of the other businesses the life insurance companies write are just being written to, so ULIP and everything is being written to really benefit the insurers more than the people who actually purchase those policies. Um, yeah. And here we see the fire has seen a degrowth. Health has seen a 123.6%. And obviously, that's quite believable. After COVID, people have become really serious about the health insurance that they're picking up. They ensure that they are adequately covered. And that is of prime importance because also medical inflation is very different to the CPI inflation that we have. CPI inflation is really pegged to food prices and those kind of things. And even that is proposed a change by the government of India. Um, so they believe that this is not the true picture or true reflection of the inflation that is on the ground. And medical inflation has been close to upwards of 12 to 13%. So it's very different from the general inflation that has been there, and being adequately protected becomes of prime importance. So here, when we look at the share of domestic to international, right? So we see that 67% of the business is being written in 78% of the business is being written domestically in first half of FY25, and 22% has been written internationally. So there has been a degrowth in international business, and this degrowth is primarily because of the company losing its A minus rating from AM Best, and that impacted a significant chunk of US business that it was getting. But now they have received it again, and this number should jump right up. All right, I think that's it from my side. Hope you have a lovely day ahead. Do let me know in the comment section what you thought of this analysis and some more of the business that you want me to look at. I would be happy to have a look. Thank you and have a great day ahead.